You've been told your biggest asset is your home, right? That your condo in Toronto or your house in Vancouver is your ticket to wealth. Well, what if I told you you might be trapped in a simulation? Today, we're pulling back the curtain on the Prairie Arbitrage, a massive, under-the-radar economic shift that shows you where the real smart capital is flowing in Canada.
All right, so here's how we're going to break this all down. First, we're going to dismantle the national economic story you hear on the news every night. Then we'll pinpoint the actual structural cracks that are opening up new safe havens for money. From there, we dive into the nitty-gritty, the arbitrage opportunity itself, the game-changing tax advantages that most people miss, and finally, a step-by-step playbook for 2026.
Okay, first things first. You have to understand that the very idea of a single, unified Canadian economy is basically a myth at this point. It's a convenient story, sure, but it completely masks what's happening on the ground. Think of it like a simulation, and we're about to show you the glitches in the code.
This quote, it just hits home, doesn't it? It perfectly captures that quiet anxiety a lot of high-skilled professionals are feeling. It's that slow dawning realization that the old rules, the default settings for a successful career, just aren't working anymore. This feeling is the first clue that the entire game has changed and a new strategy is needed. And that brings us to the key takeaway here. While all the headlines are obsessing over national interest rates and a cooling housing market, as if it affects everyone the same way, the reality is that Canada is breaking apart economically. We are not one economy anymore. We are a collection of regional economies, and they are heading in wildly different directions.
So, how do we know this is really happening? Well, let's look at the data. We've pinpointed three major glitches, three structural fault lines running just beneath the surface that prove the national story is broken. Glitch number one is what I call the productivity paradox. It's a real head-scratcher. We have a national housing crisis. We desperately need more homes. And yet, look at this. The actual productivity of our construction industry has been falling by almost 4% a year. We're getting worse at building things at the exact moment we need to be getting better.
And then there's this, the great capital drain. You hear all the time that Canada is an AI superpower because of our amazing universities. But the numbers tell a much darker story. We are basically acting as a free R&D department for Silicon Valley. A staggering 70% of AI patents coming out of our universities end up owned or licensed by American companies. We do the inventing, they get the profits. And the third glitch, let's call it regulatory suppression. Our biggest financial companies are completely stuck. 95% of them are trapped in what we call chatbot purgatory. What that means is they can use AI for really simple, low-stakes stuff like a customer service chat, but they're completely paralyzed by compliance hurdles from using it for actual proprietary money-making decisions. The tech is there, but the system just won't let them use it.
So what happens when you have these massive cracks in the national system? Well, capital gets smart, it gets nervous, and it starts to move. It flees the old, traditional hubs and starts searching for new, safer places to land. Let's look at where it's going.
This slide, right here, shows the great decoupling of the Canadian economy. On one side, you've got Ontario and BC. They're getting hammered by U.S. trade issues, and their residential investment is falling off a cliff. But on the other side, you have what we call the Trade-Insulated triangle. That's Alberta, Saskatchewan, and Quebec. They're insulated from those pressures, pivoting to Asia and seeing a massive boom in building real, hard assets. Honestly, it's like looking at two completely different countries.
And if you need more proof, just look at this chart. The numbers are incredibly stark. While residential investment is actually shrinking in Ontario, Alberta is hitting record housing starts and is seeing an over 8% surge in non-residential investment. This isn't just a trend, folks. This is a capital flight. Money is literally leaving the high-cost, fragile coasts and flooding into the low-cost, high-growth interior.
And this all brings us to the arbitrage itself. Now, this is more than just moving your RRSP from an Ontario-based fund to an Alberta one. It's a fundamental pivot in what you own, away from unproductive assets like physical housing and toward the high-performance infrastructure that's going to power the next economy.
So what does this play actually look like? It zeroes in on these four strategic sectors. They're all completely insulated from the housing drama and trade wars hitting central Canada. Why? Because they're powered by huge long-term forces, our national defense, global food demand, and the unstoppable need for both energy and data. This whole shift is creating a brand new kind of asset owner, something we call the data landlord. It's a brilliant concept. Take a company like Kraken Robotics. They don't just sell you an underwater drone. They own the invaluable high-res maps of the Arctic seabed that the drone creates.
This makes the Canadian Navy a tenant. They have to pay a subscription to access their own data, which is crucial for sovereignty. You see, the real value is in the data infrastructure, not just the hardware.
Okay, so you see the opportunity. But how do you finance a pivot like this? The answer isn't to sit around and wait for Tiff Macklem to cut interest rates. The truly smart play is a strategy that basically turns the CRA into your co-investor. This is how you generate real alpha that the rest of the market is completely missing.
The key here, the primary tool, is the Clean Technology Investment Tax Credit, or ITC. Now listen closely, this is not a deduction. It is a refundable credit. That means the Canada Revenue Agency will literally cut you a check for a chunk of the capital you invest in these kinds of projects.
And we're not talking about a small number here. We're talking about a 30% cash refund on your total project cost. Let me say that again. For every $1 million you invest in a qualifying project, you can get $300,000 back in cash from the CRA. This doesn't just improve your ROI, it fundamentally rewrites the entire equation.
Now, a 30% cashback offer from the federal government? Yeah, it sounds way too good to be true. And you are right to be skeptical, because there is one single critical catch. It's a detail that trips up almost everyone and separates the pros from the amateurs.
And here it is. Compliance. To get that full 30%, your project absolutely must meet strict prevailing wage and apprenticeship rules. You have to pay what are essentially union equivalent wages. If you don't, that beautiful 30% credit gets slashed by 2/3, all the way down to a measly 10%. Just look at this table, because this is where the real arbitrage happens. The rookie mistake is trying to save a few bucks by hiring the cheapest labor you can find. The pro move is to willingly pay the higher compliant wage, like that $54.99 an hour in Calgary. Why on earth would you do that? Because paying that wage unlocks the full 30% tax credit on the entire project cost, not just the labor. You spend a little more on wages to get a massive cash return from the CRA on your total capital investment. That is the play.
Okay, so let's put all these pieces together. Let's bring it all home and turn this theory into a concrete, actionable playbook for 2026. Here are the 4 steps. 1. Pivot your geography. Get your capital out of those fragile coastal markets and into the trade-insulated infrastructure corridor. 2. Target the right companies. Don't chase trends. Focus on the IP owners, the data landlords. 3. If you are going to build smart. Stick to missing middle-density projects on pre-approved lots in cities that have already sorted out their rezoning, like Edmonton and Saskatoon. Avoid the red tape. And 4, most importantly, comply. Make tax efficiency the absolute cornerstone of your strategy from day one. Now, to really get your mind working, here are a few examples from the TSX. And to be clear, these are not stock recommendations, but they are perfect illustrations of the kinds of companies that are built for this shift. You've got Calian, Kraken, and MDA. All IP holders in that critical defense and sovereignty space. And then a company like Badger, which is a pure play on actually building the hard infrastructure that this new economy needs. So in the end, this all boils down to one simple but profound question. The Prairie Arbitrage forces you to make a choice about what you're really optimizing for. Are you building a portfolio based on lifestyle, on emotion, on the stories you see in the headlines? Or are you building for the cold, hard math of the ledger, for after-tax capital retention? In 2026, the answer to that question is going to determine absolutely everything.